Hello, everyone. My name is Stuart McPhee, and it's my pleasure to be here with you for this Trade Zone session presented by 8CAP. Thank you very much for your time and for joining me. And obviously, thank you very much to 8CAP for the invitation and the opportunity to participate in these Trade Zone sessions. I'll be with you throughout the month of July with multiple sessions each week. This is the first of that series. And I thought for today's session, for those who have never heard me speak before, never heard of me before, I thought it was important today for you to learn a little bit more about me and the way I approach the market. And then obviously I have these sessions throughout the month. And as we go throughout the month, I'll share with you just a little bit more every session, whether it be, how to develop a strategy and what I do so far as developing a strategy, the technical analysis tools that I use. And as I'm about to share with you very shortly, I'm very much a technical analyst, whether it comes to equity trading or currency trading, a little bit about the psychology of trading and some of my beliefs on that. So again, I am with you throughout the month of July, and we will hopefully just go through some new material and build upon information as we go through that month. And as I said, hopefully throughout the series, hopefully by the end of the month, you'll have a great understanding of the way I approach the market. Probably we'll spend a lot more time talking about currencies than we will equities, but still I'll talk about both some of the risk management tools that I think are very, very important, the techniques that I use, obviously my strategy, the technical analysis tools I use, and obviously a bit about trading psychology. One of the things I thought I'd share with you first is, again, I sort of hinted at the fact that I'm a technical analyst. And I am very aware that currency markets can be very news driven, can be very sensitive to clearly interest rates probably being the number one driver. But, any central bank governor, head of a central bank says something that's unexpected can certainly move currency markets very, very quickly. Volatility can increase very quickly. So I'm very mindful of the fact that currency markets can be quite news driven. But I am a technical analyst, and I'm not going to look at any charts today, but certainly throughout the sessions this month, I will spend a lot of time looking at different charts and obviously, again, showing you some of the tools that I use and some of the techniques I use when conducting technical analysis and doing my analysis and obviously implementing my strategy. But I'm a technical analyst, so that sort of raises the question then, how much of a role does news play in my own decision making? How much role does fundamental analysis, how much of a role does that play in my decision making? And I can tell you now, not a lot. So I just wanted to share with you perhaps my perspective on this and just talk about the impact of news. Now, of course, I know we're in 2023 now, but I've just gone back in chunks of time. So if we just go back to the start of the very unfortunate pandemic that all of us, touched all of us in one way, shape or form or another. So let's have a look at the news, the significant sort of market related news there was in 2020. Clearly COVID-19 was unprecedented and clearly a significant driver and factor in financial markets and of course the entire world. At that time, we're still very heavily involved in discussions and negotiations with trade wars and tariffs and applying tariffs to products from other countries and without naming any countries, but that clearly was a significant factor in financial markets at the time. There was a lot of talk about trade wars and a lot of tit for tat and going back and forth and we were going to apply tariffs, to these goods. Oh, well, we're going to apply them to this. So there was a lot of that sort of back and forth. There was definitely Middle East tension. There were concerns about global growth. And certainly as the pandemic hit us, and I'm not telling you anything you don't know, but certainly when it hit us and everybody started to realize how big a deal this was and what an impact it was going to have on the world, then clearly there were grave concerns for global growth and the way GDPs and all that sort of stuff was going to happen throughout the year. And also related to that, and governments borrowing a lot of money. Well, of course, we had the time-honoured issue and market driver of debt, which always seems to pop its head up. And guess what? We are still talking about debt right now, July 2023, and we're still talking about debt. So that was sort of major drivers that I recall from 2020 that had a significant role on financial markets and the sort of things that were dominating the headlines and dominating, those market commentary channels when they're talking about different things. Let's just go back 5 years before that. And this is what the issues were during that time and during 2015. We're talking about the Eurozone, we're talking about Europe, we're talking about unemployment, we're talking about growth in Europe and grave concerns about various economies within the Eurozone. Unemployment levels. We're talking about growth in wages. We were still talking about Middle East tension. We were concerned about ISIS and their activities in different parts of the world or in that part of the world. And sure enough, we were also concerned about debt. So that's debt now twice. And as I mentioned, now in July 2023, we're still concerned about debt. Unfortunately, I think in July 2028, we'll still be talking about debt as well. Unfortunately, I don't think it's going away anytime soon. I can't see governments paying off all their debt anytime soon. We'll still be talking about it. It will just be really a conversation about the varying levels of that debt and how it compares to what it was previously. If we go back another 5 years, we were having just gone through the global financial crisis, the GFC. Iraq was an issue. Again, Middle East tension. Not quite the same levels of COVID-19, but we were talking about swine flu throughout Asia. I remember having some travel impacted personally from swine flu, and again, debt. So if we go back 13 years to 2010, these are the things that were driving markets. These are the things that were being spoken about a lot. If you turned on to CNBC or Bloomberg or any of these channels, this is what they were talking about. These sort of issues driving financial markets. And I'm just going to go one more again, and we'll go back a further 5 years and now go back to 2005, talking about things that were driving financial markets that year. So now we're talking 18 years ago. We're talking about the US economy and concerns about its growth, concerns about it, unemployment and the like. We're talking about the US dollar and it's struggling. In right around Christmas 2004, we had the tsunami wiping out or causing significant devastation and damage throughout Asia, certainly Indonesia and the like. So we were feeling the effects of that, and that was certainly being felt in financial markets in those areas that have been impacted by that. Again, Middle East tension, and again, debt. So don't know if you picked up or not, and this is obviously my choice that I've chosen these particular items, but none of them are inaccurate. They're all relevant and certainly drivers of financial markets during that time. But notice in every single one of them, I've mentioned debt, and still to this day, debt is a significant issue in financial markets. And the other one was Middle East tension, but that's just more of a, concerns about a particular region and the like. But certainly debt continues to be a major issue in financial markets. Now, where am I going with all this? Why am I talking about news, not just now, July 2023, but going back 3 years and then going back to 2015, 2010, and 2005? Well, the issue is, have a think about the impact of news. Here is my take on this. There is always something happening. Always. Media have to talk about something, but there is always something impacting. There is always something to hang our hat on so far as, what's driving financial markets this week, this month, this quarter, this half of the year, throughout this year. What have been the major drivers? There is always something going on. And the key for me is to not be distracted by that. It's too easy to go, I'm not sure I'm going to do this yet because I'm a bit concerned about this, I'm a bit concerned about that. Debt is an issue at the moment. This is an issue, that's an issue. There is always something going on. There just is. It's very easy to be distracted by that and the news and the noise of that. And I think it's really, really important to remain focused on your strategy, your trading plan, and implementing that objectively. That's what I think is really, really important. It's too easy to be distracted by noise. Now, I'm going to be the first to admit, and this is quite a few years ago now, but when I first got involved in financial markets, and this is trading equities, stocks, I was very interested in what market commentators were saying on television. And this is back in the day, certainly in Australia, where cable television was not that popular, and had cable television and were watching, the financial commentary on TV. And I thought, wow, this is where I need to be. This is the information I need to be listening to, because these are market experts talking about what's going on in the market. It was very easy to be sucked into that and going, well, this is where I'm going to find out what's going on in the market. This is where I'm going to find out what to trade, what not to trade. And of course, now, fast forward to many years later, I don't see it that way. But it was very easy for me in those early days to be sucked into that and thinking this was really, really, really important. And the key for me, it's almost a litmus test, is with that information being presented, I think you need to ask yourself the question, can I develop a trading strategy based on this information? That's it. Can I develop a trading strategy based on the information being presented? And it could just be, and I'm just going to randomly come out there and go, large company in Australia, BHP have just announced their quarterly report, quarterly profits. Profits are down 1.2%. Dividends are going to be this, forecast this, etc., etc. Now, me, earlier days, listening in going, wow, this is really, really important. That's important information. I need to know what's going on in the market. But now I'm saying to you, that information, can I develop a trading strategy based on that? And I'll probably put forward a reasonably strong argument that no, I can't develop a trading strategy based on that piece of news, that piece of information that I can implement on a regular basis, on an ongoing, regular basis. Because that's what we need to do as traders. We need to develop a trading strategy, a trading plan, which is a compilation of all of our rules, and we need to be able to put something like that together and then implement that with confidence in the market and implement that with regularity, ongoing, not just sort of once every quarter or once every now and again when something specific happens. So that to me is a litmus test. And what I think you'll find is, if you believe me and you sort of subscribe to this and think, yeah, he's got a point, you'll maybe start to listen to the news and go, is this really helping me? Is this going to provide me a significant advantage in the market? Is it going to help? Ask that question. Don't assume it will, please, because that's what I did. And I'm the first to admit, of course I did. That's information about the market. It must be important. This is where I need to be listening into. But I would ask yourself the question, do I need to hear this? Is it going to help me? Don't worry whether it hinders you or not. Is it actually going to help? If it does help, does it provide you a significant advantage? And if it doesn't, then maybe you're wasting your time. And I choose my words very carefully there. And I know that's a bit blunt saying wasting your time, but I mean it. Can you be wasting your time and being distracted by the noise of, news and the like? There is always something going on. Doesn't mean it's important. Doesn't mean you need to sort of be right on top of it. I'll just talk about this just a little bit more and just give you some examples. I've just sort of made these up, but you sort of see this sort of commentary. Now, I'm from Australia and I'll talk about Australian markets, but of course it could be anything. And here's the first one. So you'll read somewhere that the Australian market closed higher today, buoyed, pumped up by bargain hunters who helped to make up ground from the previous day's loss. So there were people jumping in there because yesterday fell, and there were plenty of people getting in there and, these are bargains. These are a little bit cheaper, these stocks. I'm going to go in and buy them and, push the market higher. How about the next one? Australian shares shrugged off weak offshore leads to jump higher today, propped up by some better than expected profit results. And then finally, Australian stocks fell today as investors cashed in from the previous 2 days of gains on lingering uncertainty over something. You put whatever you want in there. Over the debt crisis, over issues about, resurgence of COVID. It could be anything. Now, the point I'm making here is that typically they don't know why the market went up or why the market went down. We understand demand and supply and the like, but they've got to populate. They've got to put in a summary of the market. And they've got to say, the market went up 47 points today because of, and they're going, why did it go up? Well, I really don't know, but I need to put something in there to make sure that we're explaining why the market went up as opposed to just providing factual information. Was it buoyed by bargain hunters? They probably don't know, but they put that in there because it sounds good. It's an interesting story. Did they ring up a sample of 100 people who bought shares today and ask them, why did you buy shares today? I was bargain hunting. And 28% of people said they were bargain hunting. That's good enough for me. Now, of course, they don't do that. But they need to find, it's almost like, and I say this a bit silly, of course, it's almost like when they're filling out this sentence, market closed up 47 points today due to, it's like they have this drop down menu and they've got 12 different items they can select. And they go, well, I haven't used that one for a while. I better just select that one. And they'll go, oh, popped up by, bargain hunters or because of something. Because Australia just won a gold medal or something, some optimism. And the one at the bottom, fell today because they cashed in. Well, they cashed in. So the market went up 2 days and we had all these people, investors, mind you, that short-minded with their time horizon was 3 days. That's all they were interested in. So they're not really investors, but investors cashed in because the market went up 2 days in a row. And then there were concerns about something. And obviously I deliberately put in that insert something here because you could just put in there whatever you want. Here's the really silly one. And of course, this is just totally made up. But on the ASX, Australian market, news of possible lower interest rates, which is not really timely at the moment, the way interest rates are going. Possible lower interest rates sent the stock market up. But then the expectation that these rates would be inflationary sent the market down until the realization that lower rates might stimulate the sluggish economy pushed the market up before it ultimately went down on fears that an overheated economy would lead to a reimposition of higher interest rates. At the end of the day, they don't know, but they've got to find something. My point being is impact of news. My point being is just because people are talking and there's sort of that instant, immediate credibility because they're on TV and they're talking, doesn't mean they really know what they're doing. And I say that very carefully. There's no guarantee that they really understand the market that well. There's no guarantee they're investors or traders themselves. They are just there to present information and they do it well. But I just question you, is that information important to you? That's all I'm asking. So here's just a final summary on this. Simply ask yourself, does it help you make money? Is listening into this, following this, spending all my time, does it actually help me make money? Remember the litmus test. Can I develop a trading strategy based on this? That's what I think you need to ask yourself. Clearly, the market is driven by mass psychology, so there is something to be said about what people are doing in the market and the way they're thinking, but I'm not necessarily suggesting that people who present this information, whether it be through TV or print or online, whether they're actually gauging what people are doing and actually sampling, getting out there and asking lots and lots of people on the street to find out why they're making the decisions they're making. Ultimately, prices are moved by two things. We know that: demand and supply. And this is why I like the technical analysis side of things. And I'll make that very, very clear throughout my time with you this month when we go through different sessions and I talk about techniques I use, and we'll look at a lot of charts and show you how I analyze charts. I'm very much a technical analyst, and to me, technical analysis is all about data-driven decisions, or depending on where you are in the world, data-driven, right? So data-driven decisions, having that data, and in our case, that's price information, having that information drive what we're doing can be very, very helpful. Remain objective, be very clinical and very objective, very unemotional about the way we analyze trading opportunities can certainly be advantageous and very, very effective. And as I said, if I'm going to be with you throughout the month of July and you're going to listen in to me, I think it's important you understand my approach a little bit, certainly my approach to the market. I'm obviously going to go through some risk management stuff, psychology, technical analysis, how to put a plan together and develop a strategy. But I think it's really important you learn about my core trading beliefs. These are the things that I believe are true in the market, so you understand my approach a little bit better. These are in no particular order. We'll just go through them one at a time. Firstly, I believe trading is a process. I believe it is a logical, step-by-step sequence that you work your way through on a regular basis, always that way, always going through the sequence in that particular order. It's a logical sequence. That sequence allows you to follow all your trading rules. Remember, your trading rules are compiled together in your trading plan, and the process allows you to work your way through implementing those rules. I think when you don't have a trading plan and when you don't have a process, you look at the market very randomly. You indiscriminately look for trading opportunities. And I can assure you that is a poor way to approach trading from my experience. So it is important to develop that strategy, the set of rules in your plan, and then we have basically a trading routine, a process that we follow a logical step-by-step sequence to work our way through that plan and implement that strategy. I believe in consistency. I'll talk about this more perhaps throughout this month. In another session, I'll talk about the importance of consistency. So similar to the process and doing the same things over and over again, we need to find something, develop a strategy that gives us an edge. And when we have that edge, we can apply that edge with ruthless efficiency. Apply that edge that same way all the time. And that's the key. And I'll use the analogy of a casino, and I'll talk about that when we get to another session talking about consistency. But again, I don't want people to trade randomly and indiscriminately and just look for all these different trading opportunities. For a whole wide range of different reasons, I think it is really important to find something that will work, that resonates with you, that you're comfortable with, and then we apply that particular strategy, and we do it with great consistency. I believe less is more. I believe trading less is better for you. Now, not too many brokers will tell you this because they want you to trade and they want you to trade lots and continue to trade. But from my experience, I think trading is less is better for you. But the interesting thing is that's counterintuitive. What are we doing here? We're trying to trade. Why are we trying to trade? Well, we're trying to make money. And it sort of stands to reason a little bit. It's intuitive to think that the more times I trade, the more opportunities I'm giving myself to make money. So it stands to reason that, well, I need to trade lots. I need to give myself lots and lots of different opportunities to make money. So it's very easy to think, well, I need to be quite active and I need to trade lots. And the more I trade, the better I'll be. And from my experience, it is the opposite. And I'm not saying you don't trade, because that's a bit silly, but we need to sort of regulate and control how much we do in our frequency. And I do very strongly believe, and I've heard this from lots of different people too, and I've met a lot of different traders over the years, that the less they trade, the better their results. Anyway, something for you to think about. I've mentioned this a little bit, and that is having data drive our decision making. I'm a very firm believer in that. I'll talk about that a bit more as we go on through this month as well. And that's what I think very much underpins technical analysis. Technical analysis, is observing trends and observing chart patterns and observing, key levels, support and resistance, monitoring what happens with those trends or patterns or key levels, making observations, applying our rules objectively, allowing the data, allowing price to drive what we are doing in the market, as opposed to maybe listening in on the news or trying to do a bit of fundamentals of it or the like. I also believe that your best trades will take time. Very rarely will you get into something and very, very quickly within the next 30 minutes or an hour, does that trade explode in your favor, in the direction you want. Doesn't happen very often. And if it does, it may not happen again for a long time. You'll find that your very best trades take a long time to develop and end up being your very best trades. And that to me just sort of reinforces the importance of having that discipline and having that patience to stick with your plan and make sure you do what your trading rules say you should be doing. I'll certainly talk about this a little bit more as well, and that is don't use things. And when I say things, I mean, say, a signal, a particular technique, technical analysis technique, even something as simple as a candlestick pattern. Don't use something in isolation. Don't use anything in isolation. What you want to do is develop a signal or an idea, a strategy, a technique, but then combine it with different things. And those different things might be, looking for key levels, looking for patterns, looking for candlestick patterns, looking for trends. We combine different things to form this picture of what we think price is going to do. And then that's when we can apply, our rules to that picture, that observation, and, obviously try to take advantage of that probability, and we do that through speculation, obviously, and that's opening up trades. But I don't believe in using things in isolation. I mean, I could tell you now a simple strategy, and that is whenever you see a doji candlestick where the range from high to low is more than 50 pips, you go in the opposite direction from what it's been doing the previous 3 periods. That's a strategy right there. Is it the best? Probably not. Could we make it better? Could we improve it? Yes, I think we can. How do we do that? We combine different things to ensure that the signals we get from that are higher quality, not just quantity, but higher quality. And coming back to my less is more, I believe in quality over quantity. I think a lot of people want quantity. They want quantity of trading opportunities. I don't. I want quality trading opportunities. Quality over quantity for me every day of the week. Less is more for me. The less you trade, the better off you'll be. And finally, and I can't overstate this, and again, hopefully this comes out quite clear as you hear from me throughout the month, I believe in simplicity. I believe in keeping things simple. Certainly the simpler you keep them, the easier it is for you to follow them. But I really do believe that simple techniques and strategies do work, but that can be counterintuitive. And I tell you why, because I went through this myself when I started off. I didn't think trading would be that difficult. So we get in with all this enthusiasm and it doesn't work out and we're just frustrated, infuriated, stressed. It's not working out. We realize trading is a bit more difficult than we thought it was going to be. And when we accept that as a reality, that trading is now difficult, we intuitively think that we need to develop a complex, complicated strategy to have any chance of being profitable, of being successful. And we certainly dismiss the idea that a trading strategy can be simple. Because if I was to say, look, try this strategy, someone would go, oh, no, that won't work. That's too simple. No, trading is more difficult than that. You need something really complex and complicated. So it's counterintuitive to sort of think that a trading approach and trading can be quite simple. Again, we'll talk about this in more detail throughout the sessions, but to me, your trading plan should encompass 3 areas, the 3 M's, your money, methodology, and your psychology or the mindset. And it is really, really important that essential, critical, that you develop a strategy or a plan that is right for you, and then implement that plan with the right mindset. Can't overstate the importance of developing a plan that you're comfortable with, that just suits you, works for you, you're comfortable with, you have the confidence in, and you can implement that using that routine, using that process, and implementing the same sequence, the same set of instructions over and over and over again, every day, every hour, whatever your trading strategy demands of you. That's the key, right? Developing something that works for you, and then implementing that with the right mindset, right? The right approach, the right attitude, the psychology of it all. And again, we'll come back and we'll talk about those 3 M's in a little bit more detail throughout this month when I revisit and come back and do more sessions with you. Key performance numbers, how we can sort of monitor. These are the things we really need to focus on. And that is our percentage of winning trades, our percentage of losing trades, our average profit, and our average loss. They are the 4 key performance numbers. Traders should know what these are. They should have a rough idea of what their winning strike rate is, losing strike rate, average profit, and average loss. Simple equation using these 4 key performance numbers will determine whether you make money from trading or not. But these are the things we really need to concentrate on. And the interesting thing is we sort of get this around the wrong way. If you tell someone who has little trading experience, hey, your winning strike rate is going to be 40%, 45%, some may laugh at you thinking that is just silly. How can you possibly make money when more than half of your trades lose money? That's impossible. Not understanding the key performance numbers number 3 and 4 there. And the old adage that, of course, it's not how often you get your trades right or wrong, it's what happens when you get them right and wrong, right? That's the key. What actually happens when you get them right? What's that average profit? What happens when you get them wrong? What's that average loss? And hopefully your average profit is more than your average loss, and hopefully a lot more. And finally, just to finish off on just a quick rundown of technical analysis. Again, we'll talk about this in a lot more detail. To me, it's just an approach. It's one. It's the one I use a lot. It is far from perfect. I'll be the first to admit that it's far from perfect. I think it's quite effective, but it's certainly not perfect. It can be quite complex, can be quite mathematical. A lot of the technical indicators are really complicated formulas, and you would have no chance of doing, hand drawing certain indicators, if you just had the price information, you would have no chance of doing the mathematical formulas. That's the beauty of software and having platforms that do all that for us, but they can be quite mathematical and complicated, or technical analysis can be. Doesn't mean you need to use it in that way. Doesn't mean you need to use a lot of indicators. I certainly don't. Again, I think it can be intuitive to think that you need to use indicators. We'll talk about that another time. Even your technical analysis, I think, should be kept simple. And all we're trying to do is increase the probability, the probability of having a profitable trade. That's all we're trying to do with any form of analysis, whether it be technical or fundamentals or whatever. We're just trying to increase the probability of having a profitable trade. And whatever you do, please be consistent in your approach. Well, a whole lot of theory and sort of just running the background for today's session. As I said, in sessions coming up this month, we'll get into the charts and we'll have a look at a lot more at charts and look at technical analysis and strategies and the like. But I thought it was very important hearing from me the first time, just to understand me a little bit and the way I approach the markets and my philosophy with all my analysis and trading and the like. So thank you very much for your time for this session today. I hope you found that valuable. I do look forward to speaking to you again next, very, very shortly, in a day or two. And hopefully, as I said, we'll build upon a few things and you'll get a really good understanding of the way I approach the market throughout this month. So again, thank you very much for your time, and I look forward to speaking to you again next time.